Okay, welcome back, everybody. I think we're now broadcasting out to our remote guests. I want to welcome today, we have two distinguished guests. First is Kevin Horner with Galligan and Manning. Kevin has spoken at our conference before. They are estate and trust attorneys, and you do all sorts of stuff like elder care work, and we'll tell everybody. I mean,
the demand's right. So we do all kinds of estate planning, pretty much everyone from, small estate up through the large estate. We do the trust and estate administration. And as a component of that, I specifically do special needs work in elder law planning, which is usually things like Medicaid, long-term care planning, things like that. It's pretty much everything in the realm of estate planning or administration we pretty much covered, including some of the ancillaries such as like business work.
And I can't tell you how much we get these days requests from clients for, can you help refer us to someone who can help us with our relative and help us get things set up. And we are not able to do except some bare bones stuff at New Capital Management. This is a very, very specialized area. And so if you do need assistance in that area or just basic estate trust work, Kevin and everyone at Galligan and Manning do a great job. And I wouldn't have them up here if that wasn't the case. So, and then I want to welcome Jason Sharp also from Briggs of Veselka. Welcome, Jason. It's great to have you. Thanks for having me. Our family has a relationship with Briggs of Veselka. They do tax work for us. And you guys have just grown quite a bit. I mean, you were a Houston-only firm for the beginning of the firm, right? And now you're in many locations in Texas, right?
Yeah, we've got an office in the Woodlands. We also have an office in Austin now, and we also have an office in El Campo. You think London, Tokyo, El Campo.
You gotta have the El Campo. You're not global.
But Mr. Veselka is from El Campo, so we have an El Campo office. Yeah.
So all of you here today from El Campo, you're tax and county help. You probably noticed that there's quite a bit of, as I said this morning, discussion going on in Washington about tax law changes. And these discussions have really reached a fever pitch. Is it fair to say that that's really where it's at now? It's a fever pitch as the Democratic Party, which is in control of, nominal control of the government, but it has two, I don't know what the word is, sort of recalcitrant senators who don't want to go with the other 48 senators and all the representatives. They essentially are digging in their heels on a number of things that have tax implications. And so as a result of that, tax matters that we thought were going to be maybe resolved many weeks ago are not resolved. And not only are they not resolved, but it's like the blueprint keeps getting changed quite substantially, almost on a day-to-day basis. And so I thought I would just start by asking this really, really, precise question, really, really precisely put. What the hell's going on?
I'll take a stab at that. Not that anyone's an expert in that before, but a lot of back and forth and everyone trying to come to some sort of a resolution. So to kind of explain that, if you followed anything politically in the last year or two, it's tumultuous. And all the proposed tax changes are no different from that. And of course, the government has been looking to raise uniform revenue for a host of reasons. And what has really been interesting from my perspective is the number of aggressive proposals that have been made in the last year, and so far none of them have actually stuck. So by way of maybe explanation for what I do, focusing particularly on the estate and gift tax, there were proposals beginning this year or discussions to radically change the estate and gift tax. There was everything from changing the tax rate, which is already at 40%, to make it perhaps a graduated one, 45 if you were a certain size, 50 or up, depending on the size of the estate. There were discussions about changing the actual tax exemption If you don't know this currently, you can have about $11.7 million in your estate, and that's in form of what you can give away or die out. And that's how much you're allowed to have before you owe the estate tax.
And double that for married couples. Sorry, Kevin, but
In most cases, yes.
in most cases, right? So with this portability idea. Sorry to jump in.
No problem. So it was been historically high, and everyone knew that was going to change. And so there was even discussions to put it all the way down to 3.5 to 5 indexed to inflation, all that sort of stuff. And so what's happened this year is all of those things have been suggested. There was another suggestion that we would do away with step up in basis, which is basically the idea of if you sell an asset after you die, such as something like that, there'd be no gain because your basis in it was equal to what it was in death. Great tax advantage people. All of those things were discussed, and so far none of it has actually happened. And it's gone to quite a lot of different directions with, as of literally yesterday, none of that is still on the table.
How do you see it? From your perspective, Jason?
Yeah, so I'm going to probably come at it more from just a pure income side. You know, he's more on the estate gift and trust side. On the income side, and I joked when we first talked about doing this presentation, I said, you realize I hate talking about proposed legislation because whatever I tell you is wrong, because it is just a proposal and it will not be whatever is final. And I think I told him I had seen a interview with a NASCAR race driver, and he said, someone asked him, when you're racing in a race and a car is spinning out in front of you, how do you know whether you should go left or go right? And he said, I don't do either. I drive straight at the car because I don't know if it's going to go left or right, but I know it won't be right there. And I feel like that is proposed legislation. I don't know whether it's going to get worse, get better, but I know it won't be what we tell you it is today because it's always going to be negotiated down. So I always hesitate a little bit about putting too much stock in talking about proposed legislation, but I think it's smart to be aware of kind of the things, or like he was talking about the attitude of Congress and what they're doing. There's also a lot of talk I hear from a lot of my clients and other people. It's like, well, Biden wants to do this. And you have to kind of realize that we had Biden's plan when he was campaigning. Biden issued a budget proposal in April that had some tax things that were different from the campaign. The House Ways and Means Committee issued proposed legislation in September that is supposedly Biden's plan. It was very different from what was done in April. And then just yesterday, we got about 1,700 pages of proposed legislation, many of which had tax provisions. And so all of these are quote Biden's tax agenda, but they're all a little different. And so I think we've just maybe tried to talk on some of the things that are common throughout, the common themes or the aggressive nature, things like that. So yeah, there's definitely a lot going on.
And if something is passed, what timeline should everybody be thinking about for the changes to take effect? And what is everybody in the room and listening out on the feed, what do they need to think about? Is it the next tax return that they're going to be filing this coming April? And so there's going to be as there was a few years ago, a short fuse between when it's passed and when all that happens? Is it like that? More than likely?
So Congress can make retroactive tax law. Some people think, I mean, I kind of have a problem with that fundamentally. It's kind of like changing the rules in the middle of the game, but they have done it in the past. It's actually been upheld by the Supreme Court. It is legal to pass retroactive tax law. Now, they usually don't do it. We had the TCJA, the Trump tax law here a few years ago. It had some retroactive provisions in it. Some were beneficial to taxpayers, some were not beneficial to taxpayers. So to answer your question, it's entirely possible that some of it would be retroactive. And when I say retroactive, meaning to tax year 21 for the return you're filing in 2022. For an example of that has gotten a lot of publicity is the capital gains. If the capital gains rate potentially is raised, again, Biden had talked about it being as high as 37, basically no preference to capital gains. The September proposal from House Ways and Means only was a 5% bump in capital gains. but it was retroactive to September 13th, which was the date of that release. So to answer your question, if something like that were to get passed, then yes, I would have a change potentially in my capital gains in April for gains that I picked up after September 13th. So, and I don't know, you may be aware of some other changes.
I am. And so I think at least more like in the estates and trust realm, and probably the biggest proposal changes so far for my area were what was suggested in September. Now, if during the course of this talk, I'm sure I'll probably go through the vast majority of it, but that one in particular talked about taking the estate tax exemption and having it. All right, so it would go from about 11.7 and it would go down to about $6 million in change, and that would be starting in 2022. So January on would be 2022, or excuse me, we did a $6 million exemption. And a lot of that proposal also included the express negation of the estate plan tax. I won't go through all the technicalities of that, but a lot of techniques that people like me have used for a very long time to get certain tax benefits were going to be expressly cut off. What was interesting about the timing of that is most of that proposal, again, has not come forward so far, but some species of it does. This will probably be how it plays out. Most of those were designed to take existing estate planning documents and grandfather them in. So it would be anything that would be executed after 2022. And so actually, frankly, when that first came out, that led to kind of like the rush of people trying to get things done to plan while we knew what the rules were. And so I think for the estates and gift tax, that appears to be the timing of it. Now, that doesn't mean it couldn't be retroactive. That's been suggested in the last couple of years. What is also really interesting to me about the timing of it is even if it's supposed to apply, or most of these changes would apply to things done in the coming year, most of the rules also say it depends on when you fund things. So like I'll just give you a really easy example is like a life insurance trust. I'm actually just mildly curious. Does anybody here have a life insurance trust? Know what they are? Sophisticated group. I have one. So it was a very, very old estate planning technique. And the basic idea is you would use a trust that would hold a life insurance policy because you don't need to value the life insurance policy when you're alive. You need it when you die, right? And that would have a balloon effect on your estate. So you had a trust designed to hold the policy. You would pay the premiums into the trust, and the trust would actually pay the premium. And you did that for post reasons, but primarily to get that outside of your estate. And those kinds of trusts were typically granted. And so one of the things that would change is if that trust was already existing, so you did that same style of trust in 2022, that trust would no longer be outside of your estate, it would be part of your estate if it was designed as granted. Now, for all of those ones that would be granted, where they took it a little bit further is it would also apply not just to the trust of the grandfather, but if you continue to fund it. So like the life insurance trust, you put money into it every single year. So even though it was a grandfathered in trust, you're actually continuing to add money to it. And so what you add to it would still go back and be part of your estate. So the timing question is interesting for what I do, because even though it's for the most part designed to not apply to things until they've been executed here, there are ways that that can kind of come back to you for things that you've already done. So it'll be interesting times, at least.
Jason, in recent days, we've seen emerge this idea of taxing billionaires on unrealized capital gains. That's a first, right? That would be a first in American tax policy.
Yes.
And I'm just wondering, what is the reaction among CPAs about this idea? Obviously, it'd be great to, to have the billionaire as a client, but I'm just wondering, what is the reaction at your firm and among other practitioners? And is there some thought that, well, if it starts there, it could eventually reach everybody, and this could become the law of the land for everybody in terms of capital gains?
Yeah, I think it's interesting because there's been no mention of that in the proposal that was made yesterday. So a lot of people think that is kind of falling off the table. It got a lot of fodder, obviously, because I think it is so revolutionary for American tax system. Again, so the idea there is, you read this article that, Jeff Bezos or Elon Musk, their value went up $50 billion this year and they didn't pay a dime of tax. Well, the reason they didn't pay a dime of tax is because all their value is in Amazon stock or Tesla stock. And if they don't sell any of the shares, they don't have a gain to trigger the tax. So the idea is, well, we're going to tax them on the value increase, whether or not they actually sell the shares. Maybe that's a nice theory to raise revenue, but I think most practitioners, to your question, just sort of scratch their heads because administratively, it would be an absolute nightmare. You could maybe do it for Bezos and Musk who have publicly traded stock. But to your point of how far, are they going to try and increase that? Well, what if a privately held business? I have no idea. Are you going to do a valuation every year to see if your stock holdings increased in value? What do you do when it decreases? I mean, so if Amazon were to tank next year, does Bezos get a $50 million loss to carry back? I mean, I think it's an interesting idea purely theoretically. I think most practitioners feel when you try and look at it, how you would administer it, it would be an absolute nightmare, and it's not really applicable, and it doesn't really move the needle.
And yet here in Harris County, every single year, we do that with homes. That's true. With every single year, Harris County looks at everybody's home, and essentially there's an appraisal process, exactly what you were just talking about with regard to private business. And people pay a tax based upon that value. So it seems to me there's precedent for that, and it goes on with all of us in this room every single year on the taxation of our homes. And so it would be something like that.
I think that the complexity level, though, is just exponential with people's businesses. I mean, it's kind of easier with a piece of property. They can look at real property records and they do a drive-by appraisal and everybody just goes up 10% or whatever. I mean, I think it's a little easier, but if you start having businesses trying to say, well, how much did your roofing business increase last year? I mean, that would be impossible absent hiring someone to evaluation.
But if they do it, you guys will be ready to.
We do valuation, so yeah, maybe I should be pushing through this, right? And back to also, I think it's good political fodder, and even on the estate exemption we're talking about. I was sharing with him, beforehand, the IRS actually produces a chart showing where revenue comes from the IRS. Where do they get their money? And this country is bought and paid for with borrowed money, payroll taxes, and 1040s. As of 2019, 5% of the gross revenue of the government came from corporate income taxes. 6% is all excise, custom, estate, gift, and miscellaneous taxes, which is like gasoline taxes and stuff. So corporate tax and all the estate taxes is 11%. Everything else is 1040s and stuff. And so if you have 700 billionaires and you somehow impose this really ridiculous tax on them, it's not really going to move the needle very much. It's great political fodder to say, oh, we're making the rich people pay their fair share, but it's not really going to do very much fiscally, in my opinion.
But if it did get implemented, and then that type of taxation would have a beachhead with somebody who's extremely wealthy. For people in the room who have unrealized capital gains, the concern there would be that form of taxation, if it were to be feasible, popular, whatever it is, that eventually it could reach everybody who would then be taxed on their unrealized capital gains, who in this room hold portfolios in their tax accounts. That's a possibility, is it not? I mean, that's a...
I think it's very unlikely, personally. I think it's great political talk, but I think it would be so hard to administer. Now, I said that, I believe there are countries in Europe that have a similar sort of market-to-market aspect to it. And it might be possible, publicly traded where you have, very crisp, regimented valuations. But I just really don't know how they could administer it very well. I think it's going to get a lot of pushback. And Again, is the car going to spin right or left? I really don't know, but I just think it's very unlikely that this will ever come to pass.
What about on the, get you a second, but what about on the corporate tax rates? There's been a lot of controversy about that. There was the decrease in the corporate tax rate when President Trump and the Congress, what was that, 2017?
For tax year 2018.
For tax year 2018, the rate went from what to what?
The highest rate was 35. It was a graduated rate up to 35 and dropped to a flat rate of 21.
So 35 to 21%. And the conversation there now is, does it go back to, I think 27% was the discussion, right?
So back in September, there was some talk that it would go up maybe to 25, 26, 27. A lot of folks thought that's where it might end up. The proposal yesterday had no discussion for a change, which is very interesting because I think people thought, okay, it's not going to go to 35, but they'll maybe bump it up to 25 or 26. And I think a lot of practitioners, folks in my business thought, yeah, that's probably where they'll end up. So it was a little curious yesterday that in the proposal yesterday, there was no mention of it increasing. There was, they sort of have this concept of a minimum tax of 15%, which is apparently sort of a global thing of they want companies to pay a minimum tax of 15% on their book income. So what that means is, I think what they're frustrated with, and again, part of this is maybe politically fueled, but part of it is fiscally. You have a company like Apple that is, just printing money, but because of the way they can structure a lot of their stuff from a tax perspective, they pay very little tax. And so they're talking about saying, okay, fine. If your financial statements say you had book income of $100, you owe tax of at least 15, like as a minimum. And that is still perhaps on the table, sort of this global minimum tax with a lot of other countries as well. So if you're operating in another country, the minimum tax is going to be 15%.
But that seemed, my understanding from the news I've read is that that's actually close to completion on a scale. Is that right or wrong?
Well, there's been I don't know how I don't want to say completion in terms of how it's going to happen with the IRS. But yes, there has been agreement among several of the countries that we need to have a global minimum tax at 15%. And I think one of the proposals yesterday was there's a few countries that have not participated in sort of, the party to have a minimum tax, and there are penalties for, operating in those countries and things like that to try and enforce them for everyone to have a global minimum tax.
Kevin, this idea of the step up being eliminated, that affects people here. And what would that mean if the step up is sort of in practical terms? What would that mean for families passing wealth from one generation to the next if that was to go into effect?
Well, I'm going to give you two answers to that. One, chaos, at least on my side of things. And then two, maybe obviously more capital gains tax. So it's interesting when this was proposed, or like some of the questions you guys were just talking about, I heard it put that some of the earliest proposals, the tax proposals, especially going to the beginning of the year, was kind of driven by this populist hatred of the rich. Like there's clearly perception there's too many people with too much money for building rockets, going into space, and that shouldn't happen. So we need to find a way to be really aggressive about things that are perceived techniques that those people are using to save on money. Right? So part of the idea was that things like the step up in basis was sheltering capital gains for people. So again, I'll explain this because it is important to make sure you understand is that if you acquire an asset like stock at $100, you sell it for $500, you pay the taxes based upon $400. And so the step up in basis is when a person dies, if the asset is inside of their estate, instead of acquiring it at $100 and then selling it at $500, which is what it's worth, the step up in basis says your basis becomes equal to what it is at death. I had a law school professor put it as this is the one don't kick you when you're down rule that the IRS has because you just lost a loved one. Oh, and by the way, here's the tax code. And I don't know if that's exactly true, but that's sort of perception. So what it would mean if we can have that is, of course, a very wealthy person would pass away and they would have a lot of stock that then gets given off to their beneficiaries, and the beneficiaries then sell it, and they would have the gain equal to whatever their initial basis was to whatever it was when they sold, right? They would get that there. I think why it was problematic and didn't really get anywhere is it doesn't just affect the Jeff Bezos of the world, but my attitude with some clients is that affects the little old widow, right? Because if they buy the house 50 years ago, right, and they bought it at $30,000, and they die 50 years later and it's worth $200,000, their heirs are going to have a huge chunk of that inheritance taken out, because by the time they sell that house, they can't live in it anymore anyway. They're going to take all of that gain, right? And so I think the practical side is so many more transactions post-death are going to have a capital gains component, and therefore would certainly increase the taxes. But from my perspective, I think the other reason why they didn't really have it go anywhere is it would be chaotic. Because if you're preparing the tax return to show what that cost basis is, how do you actually know what that person bought that house for 50 years ago? Do people typically keep those records? If they have the house, you might be able to find it somewhere, but most of the time you can't. What if it's a car that you didn't buy all that recently, right? Or what if it's in theory something like personal? You might not have what you bought it for, but you have what you sold it for later on. So I think it would certainly increase tax, but it was always going to be problematic because it would require a level of tracking and tracing those things that people just don't always do in all of those contexts. I mean, at least outside of things like stock or where there's
maintained set records. You were also talking about the estate and gift tax exemption being lowered.
Yes.
And you talked about it going from $11.7 million per person down to $6 million a person. And so for people in the room and watching, what does that mean? Who should be thinking about, well, if that happens or may happen, I need to maybe take some action, and what action should they think about, and when should they think about it? If it's something that comes out 2 weeks from now and is suddenly in existence, and sort of what estate sizes might be caught if they make that reduction in the threshold.
So that's an excellent question, because for this, and we talked about some of these proposals are very diverse in how aggressive they were, or things that don't appear going forward, like the September proposals that would affect the estate tax currently. The one thing we do know from all of this, and to kind of explain the background of the estate tax, is the estate tax is 11.7, which is higher than it's ever been. Right? And every year it was designed to go up a little bit indexed to inflation. A number of years ago, it was less than $1 million. Right? And so we actually live in one of the higher estate tax exemption climates that we ever have. And currently it's the highest ever. The way it currently works is there was a law from quite a while ago that essentially set the exemption at $5 million per person, and then Trump doubled it. That's why it's 11.7 per person. Leonard mentioned this earlier, but also for married couples, there's the concept of portability. And basically what that means is if you chose to file an estate tax return when one spouse died, the other spouse got to use their exemption if they didn't use it. So really it meant for a married couple, currently you could have basically $23 million before you have to worry about estate tax. The way the law was written when it made it 11.7 was that it was always supposed to sunset. It was always supposed to go back down to what it had. That was going to be in 2026. And then based upon having a blue president, and then that was even before COVID and all of the problems that created financially, everyone knew it was going to change soon, right? Most of the suggestions in that September proposal kind of confirmed this idea would be that it would probably go back down to $5 million next to inflation, which is where we get to 6, and that would be in 2022, right? So with that sort of background in mind, the timing of your action is probably now, all right? And that's because, one, we know you still have $11.7 million per person until January for sure, right? It may not change starting into the next year, but it certainly could. Or if it changes in the next year, it could also be retroactive to the beginning of the year. So we know for the next 2 months, unless Congress changes its mind, which may hypothetically happen, it should be 11.7. That also means that the IRS is taking the perspective of it's a use it or lose it type of thing. That means if you make no gifts and next year you go back down to 6, you've lost the double effect. Right? But it also means is for people who especially are, say, have maybe 11 plus, right? Married couple or not, if you're at 11 plus, one other aspect of this is if you do make gifts this year, all right, which a lot of people are doing, if you make more than $6 million, you're going to use that extra exemption. You have to make at least $6+ million fully utilized. But what it means is most people, when they can, you have the assets that facilitate this, the network facilitate this, will make substantial gifts by the end of the year. All right. Now, who should be thinking about these kinds of things? It's a little bit hard to say only because if the trust rules change, like the September proposal has, some of the techniques you already have in place may not be working going forward or may have the trap of losing some benefit retroactively. Okay. So for that reason, I would say anyone that has $6 or more million, married couple or not, probably wants to have it at least looked at this year. All right, because there could be planning opportunities that are going way up. That. Beyond that, people who really need to be worried, if it's a married couple, probably, I'm going to say 10, because of course, depending on your assets, you don't actually know what your value is going to be like. Then if you have a business, it's a little bit hard to define. So if it's a married couple with say $10 million or more, then you absolutely want to have what you have looked at now, because you might need those planning opportunities that could go away. And certainly for a single individual, $5 or $6 million, going absolutely please look at it.
Okay, so let's switch gears a little bit to the individual tax side of things. There have also been quite a lot of changes in the recent years to deductions and changes to the deductibility of mortgage interest, and to property taxes. What remains in terms of deductions that are available to people as we approach the end of the year? And what should people be thinking about and looking at, something they could do if they need a deduction and they have income now, they want to do it again? What's left?
Yeah, I wish I had some magical answer. The Trump tax law lowered rates and offered some tax savings for a lot of folks, but they also took away some deductions. So a lot of the, investment advisor fees are no longer deductible. The state taxes are capped at $10,000, which doesn't, it impacts us in Texas with real estate taxes and so forth, but it really hit, the states with income taxes hard. That's been getting a lot of press lately because most people assumed that's an easy one to have Congress change and get rid of that $10,000 limitation. Yesterday's proposal had no mention of it. Some of the commentary that's come out this morning is that will change, even though it wasn't really in the legislation yesterday, that they want that $10,000 cap to go away.
So that the tax paid would become fully deductible.
Right. What it used to be,
no longer capped. What your property tax is now fully deductible.
So if I pay some tax in California, I pay some tax in New York, state income tax. If I have sales tax in Texas, I have property taxes. Those are all now capped at $10,000. The thought is that'll go away. Now, one of the proposals I saw read today is that they'll make it unlimited for the next 2 years. It'll go back to the way it was for the 2 after that, and then maybe something else. So who knows what will be the final negotiated answer. But I found it interesting. It was not in yesterday's proposal, but most of the talk is that it's expected there will be something on the state tax side. There's just a lot of states that's impacting so much of their constituency that they want to do something with it.
The charitable deduction remains a potent tool, does it not?
Yes.
Talk a little bit about that, and there were changes made. It used to be capped or phased out, and my understanding, a limited understanding, is that it's not as capped as it used to be, not as phased out as it used to be, and that people now give charitably and get more of a tax deduction for it.
Yeah, it's up to 60% of your adjusted gross income, and there's also some changes.
Fully deductible 60% of your gross income. So your gross income is $100,000 for just say the round number. You could give $60,000 in a charitable donation, and it's 100% deductible against against your AGI.
It becomes one of your itemized deductions. And if you were to give away more than that, you would be capped at the 60, but it would carry over to future years.
So if you give 70,
you would have
60 would be deductible, 10 would roll over to the next subsequent year. You wouldn't lose the charitable deduction.
Right, and some of these changes are, you have to realize, it's funny, we get tax changes about every 10 or 15 years, and it seems like we've had 5 of them in the last 3 years. It's because the CARES Act and so much stuff that was done with the pandemic, there was actually some charitable tax provisions in that. So that's kind of tweaked this a little bit, just in the recent last couple of years. But I think those rules are obviously, that is one way to get a deduction. And I've had many clients like to take advantage of that because they feel like they would rather make a donation to an organization they feel good about as opposed to donating.
Or to their donor advised fund also. We do a lot of work with donor advised funds, and so people have that option as well, which is to make a contribution to your Fidelity charitable account, and you get the same deduction, and you can give the money away, on a spread out basis rather than having to give it. So from my perspective, charitable giving remains a very potent way to impact your bottom line for taxes. We just have a few minutes left. Is it getting more difficult with all these changes that have been going on, or is it just normal that you guys are constantly dealing with tax law changes, or things ricocheting back and forth more rapidly with more volatility than they used to? And how do you guys stay on top of it if that's the case?
So if I can answer that question, I would say, especially this year, the variety and the severity of the changes is what we didn't always see in the past. Like there might be one change, like for example, Leonard mentioned before, the concept of portability, which is where if you have one spouse with state tax exemption, the other person can keep it. That wasn't a rule, say, 10 years ago. And what it really did actually was make our lives easier. We used to have to use more complicated estate plans to get that same result. Now you can select it, right? And that was a big change. We've kind of kept it. And this year, when we had the conversation of the loss of the step-up basis, and by the way, I think that rule is older than I am. So, I mean, that would have been a very big shift, or the income changes that were suggested in September has made it, for me as a practitioner, very frustrating, because I feel like, if the September proposal had gone through, we would be in a mad dash to do as much and solve as many problems as we possibly could. I saw one commentator say there's not enough lawyers in the country to deal with all of these problems. Like we got to sit sometimes. And so from my perspective, it's frustrating recently because they're so different and they're so big. Change, maybe not all past, but frequency of them and the severity of them has been very much the best thing I can tell clients is here's what the possibilities are. We're planning for the future as much as we can. And remember, it's now, because right now we know what the rules are. It's tomorrow we can't always fully predict. So act now, build as much flexibility into what you're doing as you possibly can. We do things like include and trust, the ability to do what's called can't. Basically to build a new trust in the future if the first one's broken, and add all your stuff in the second one. It's a do-over, basically. And so, so what we have to tell people now is all of these things are being discussed. Stick with what we know, prepare as best you can for the future, and stay educated.
Maybe time for 1 or 2 questions. Anybody have anything? Gentlemen, thank you so much for your time today and your insights. I know it's a really, really sort of confusing time as we wait to see what's going to come out of it. We are really grateful for you sharing your wisdom and your thoughts about it. And let us know if anybody would like to be put in touch with either of these gentlemen. You can contact them directly, or we're happy to put you in touch with them. If anything that we've said here causes you to leave and say, I think I need to maybe have a conversation then by all means, we'll help facilitate that. And I can vouch for both of the firms that do excellent quality work. And it is a really great pleasure to have you here today and to hear your insights. And hopefully, whatever comes out, you guys will get some rest, sleep, and it'll be done this man. So thank you very much. How about a round of applause?